a general comment that I think is contrarian to what many folks who create content about real estate, especially a lot of folks who create content about multifamily syndications, etc., talk about, which is it's okay to use alternative financing. And if you're an LP who's listening, it's okay to invest in a deal where the sponsor is financing with alternative financing. You just have to understand the reasoning behind it, the mechanics of that financing, what the business plan is, and the overall picture, right? It shouldn't be an auto DQ like a lot of folks will make it seem on LinkedIn, Instagram, podcasts, whatever. What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. In this episode, I'm going to do a bit of a deep dive into how we think about debt and lending within our business and how we actually think about securing debt, both from the lenders that we like to work with and the terms that we really prioritize when working with lenders in our business as we're taking down deals both on the buy side and refinancing deals after we stabilize a property. So I want to talk about the big four principles that we come back to in our business as we evaluate different types of debt options and different lenders. And I think this is going to be an extremely tactical episode for all of you listening. So let's get to it. So while in this episode, I'm going to get to the four core principles in regards to how we evaluate different term sheets, different debt options in terms of like types of debt, and different lenders within those different, verticals, whether it's bridge, banks, credit unions, agencies, etc. I want to just start with how we think about using debt. I think there's a lot of folks out there who, especially in the world of real estate syndication, who are going out there and raising capital that are extremely rigid in regards to how they communicate the debt that they use. And a lot of that has to do with just seeming as if they're better than their competition. So for an example, you'll see a ton of syndicators out there talking about how they never use floating rate debt. They only use stabilized debt. They only use fixed rate financing. They only use 10 plus year terms or whatever. And they speak in absolutes and in kind of binaries, always and never, etc. And a lot of that is, to put it mildly, I think a lot of folks say that who are out there raising capital as almost like a virtue signal, right? I'm so concerned with the security of my investor capital that I would never even entertain using this debt option. And I think that a lot of folks are doing that now because it's easy to score points by saying that after the last few years of people using floating, et cetera, and getting into trouble as a result of it. Now, with that being said, we don't use floating rate debt. We typically use longer term fixed rate financing. So we do those same things. But sometimes there are deals that call for some types of alternative financing. We still buy deals in our business with bridge debt. And a lot of people associate bridge with floating, and they think that those are the same thing. And that's not necessarily true, I should say. Bridge debt can be shorter term and fixed rate in nature. You can get fixed rate bridge loans. They're typically just slightly higher interest because they're okay with lending on a slightly more distressed asset. And usually that comes with a slightly higher LTV, maybe some construction funding as well. And we pursue a lot of projects that will not qualify for stabilized financing on the buy side because there's a lack of debt service coverage, there's an element of distress, there's a timeline associated with the deal that requires us to get it closed more quickly, and we don't have the time to work through a traditional financing process. So in our business, we will regularly use alternative financing, bridge financing. Now, when we do use that financing, again, not all of our projects, a smaller percentage of our projects, we still fix that rate, even though it's a higher rate. We still don't want to, exposure to rates moving up and down while we're working through our business plan. We still typically look for a longer term with an extension option so that we're not forced within 12 months or 18 months to do something. Typically, we want to see a 12 to 18 month term with an extension option, which is enough for our smaller deals because we buy much smaller deals than a lot of the folks out there that never use this financing. 12 to 18 month financing, even if you have an extension option on a 150 unit asset, is very risky financing fundamentally. On an 8 unit deal, on a 12 unit deal where you're going to finish the business plan in 6 to 9 months, and there's all kinds of buyers that can take down that asset in 30, 45, 60-day closing timelines. If you had to sell it, it's a little bit different. So the reason I say all this is I think it's important to understand that there's nuance in the real estate investing business, and you have to align your financing with the deals that you're pursuing. And they have to match, right? They don't have to. You don't have to do anything, but it's best if they do. You don't really want to use bridge high interest rate financing on a stabilized asset unless there's a real compelling reason to do so. The seller's willing to sell it to you at this greatly discounted price, but they need to close in 30 days or 45 days because there's something going on behind the scenes. Okay, maybe then it makes sense. Inversely, you don't really want to try to force stabilized bank, credit union, or agency financing on a deal that has high vacancy, needs a lot of work, and doesn't have a lot of debt service coverage. You're either going to get low LTVs and bad terms, or the deal's going to fall apart as you're working through the underwriting. So, with all that being said, I preface these four big principles, which I'm going to get to, and that's going to be the meat and potatoes of this episode, with a general comment that I think is contrarian to what many folks who create content about real estate, especially a lot of folks who create content about multifamily syndications, etc., talk about, which is it's okay to use alternative financing. And if you're an LP who's listening, it's okay to invest in a deal where the sponsor is financing with alternative financing. You just have to understand the reasoning behind it, the mechanics of that financing, what the business plan is, and the overall picture, right? It shouldn't be an auto DQ like a lot of folks will make it seem on LinkedIn, Instagram, podcasts, whatever. So let's talk about our four big principles. And I'm going to confine these four big principles as it relates to working with stabilized lenders, because I think that simplifies this conversation in a way that's a little bit more actionable and applicable for the listener base. So, four big principles when working with folks who are extending, I shouldn't say folks, institutions or stabilized lenders who are extending financing that is meant to be collateralized by stabilized property. So we're talking about local banks, regional banks, talking about local credit unions, regional credit unions. The agencies would fall into this, although we don't work a lot with agencies, and I'll maybe briefly discuss that at the end of the episode. But this is, you're buying a deal that's fairly stabilized, or is stabilized, or you're refinancing a deal where you've just executed a business plan. Our four big principles, and this is for us, right? I'm not saying this is the right way to do it. I'm not saying it's the wrong way to do it. There's a different approach for different risk profiles, different investment types, etc. This is what we do in the world of value add, small to mid-sized multifamily. Number one, big principle that we care about, big component of working with a lender or a term sheet that we care about is flexibility in exit. So what that means is, really, that's just another way of saying we want minimal prepayment penalties. A lot of lenders will offer you a more competitive rate, but in exchange for extending that more competitive rate and offering a more competitive rate, they want to tie you up with more disadvantageous prepayment penalties to the borrower. And we're yield maintenance if we're talking agencies here. And we really try to avoid signing term sheets with banks that have significant prepayment penalties because we hate to feel locked into a loan and for that loan to affect our exit strategy and impact our ability to either sell or refinance that deal. And this is only significantly exacerbated when you work with agencies where you are essentially locked in if you have real disadvantageous yield maintenance for like the life of the loan. And the amount of times I've seen investors find themselves in tricky positions where the market is such that it makes sense for them to sell, or something happens behind the scenes where they need to access that capital for another project, or they have a change in market focus or product type focus and they need to sell, or this project is just getting a little bit out of hand and maybe it's requiring more capex, or there's something specific to that market or that property that dictates that they sell and then they can't really sell and their hands are tied. And obviously this is a spectrum, right? There's a spectrum of how significant prepayment penalties can be. You can have anything from yield maintenance, which is very disadvantageous, if not, makes it really, really impossible to sell unless rates have risen in that period of time and you're not actually being penalized that significantly. Or you could have, a minimal prepayment penalty, like maybe a 3-2-1, 3% year one, 2% year two, 1% year three. I mean, the farthest end of this spectrum is like no prepayment penalties, right? But as you start to back up, maybe it's a 3-2-1 or a 2-2-1-1-1 or a towards the middle of the spectrum is a 5-4-3-2-1, what we call a step down prepay. There's also language around, is this prepayment penalty only levied if they refinance with another financial institution, or is it levied in that situation as well as a sale, any prepayment of the loan? So there's all kinds of different versions of this, but in general, we like flexibility because I do not want to feel as if I am not able to refi or sell a property because of the debt that's against it. And the other big thing here is when you pay a prepayment penalty, it's just, gets tacked onto your payoff and it significantly eats into your equity and your proceeds. And the outsized impact that it has on your returns is far more than the 3-2%, whatever the number might be. It's a much larger percentage of your capital invested in the deal and much more significantly impacts returns than just that nominal percentage that it may seem like when it's in a term sheet. So for us, we like working with credit unions for one reason, that they typically don't have prepayment penalties, if not never do. And that's a very broad statement, but they less frequently than regional banks, local banks, and then obviously the agencies. We're comfortable paying a higher rate. We're comfortable paying 6% versus 5.8 or 5.85 if that means we're negotiating away or seriously negotiating down the prepayment penalties. And again, that's specific to what we like to do in our business. Maybe different in yours, right? You have a different risk profile, different investing strategy, but that's what we care about. Number two, we strongly prefer working with lenders that are comfortable with longer interest-only periods that are also not requiring us to escrow funds, whether that's taxes or whether that's taxes and insurance. And the big reason is we want to control as much of our cash as we possibly can. We do not want to relinquish control of our cash to a lender. And that's more directly applicable with taxes and escrow, right? We would rather just pay them when those bills come due versus sending the money to the lender, who oftentimes collects more than they need, and then who oftentimes it's a little bit harder for them to issue a reimbursement at the end of the year. If not, they keep rolling it over. So for us, we would much rather control that, right? So that's the escrow piece of that. On the interest-only side, we want that interest-only period to be as long as possible. Obviously, it lowers your debt service, allows you to generate more cash flow, and that's a positive, right? That said, there's a lot of investors who are maybe less experienced that like the idea of amortizing their loan down and paying it off over time, which, sure, that's a great position to end up in if you own a building free and clear over a long period of time. However, that is not the most financially optimized way to invest your capital, right? The most financially optimized way to invest your capital is maintain leverage that does not cross a threshold into being risky, whatever that number is for you. Maybe it's 60%, maybe it's 70%, whatever. But one of the strongest advantages of investing in real estate is utilizing leverage, right? So we want to utilize that leverage as best we can. And then on top of that, we do not want to be sending money to the bank, relinquishing control of our capital to the bank, which is fundamentally what you do when you are paying down or when you're paying amortized loan payments. A portion of it's going to interest, a portion of it is going to paying down the loan balance, right? And what you're doing is you're paying down the loan balance, which therefore moves your dollars over to the bank in the sense that you're paying down that loan balance. And now it costs you money to go and access that capital again because you have to either refinance or sell the property to access the equity that you're creating by paying down that loan through amortizing loan payments. Now, the other way of thinking about that is loan payments are lower, more money in my pocket, more ways I can go out and allocate it, right? Whether that's go buy a new deal, whether that's make distributions to my investors and pay down my preferred return or stay more current with my preferred return. It's advantageous to investors who are looking to financially optimize and earn the highest and best returns to not pay amortized loan payments, to make a very long story short. Now, if your interest rate is extremely low, there's a little bit more of an argument because your loan payments have such a higher percentage towards principal, and maybe for you, your goal is you want to pay down that loan balance. It's a more it makes more sense for you on a risk adjusted basis to do that. You like the idea of lowering your loan balance. You understand that you could make more money if that wasn't the case by reinvesting into other deals or opportunities, but you don't care because you want to pay down your loan balance. Okay, sounds good. That works for you. But if you're someone who's trying to maximize your returns, you want to be retaining control of your own capital, which means not making amortized loan payments and not sending capital to your lender for escrow payments. Big principle number 3, we care about debt service coverage ratio more than we do LTV. And I think it's a better measure of the risk profile of a loan than LTV is. And the quick example of this is comparing a high cash flow deal in the tertiary market to a low cash flow deal in a primary market. 75% LTV in both those situations is an apples to apples comparison. Let's say you have one property worth $1 million, you have one worth, or both properties are worth $1 million, $750K on both. The $1 million property in the tertiary market is probably generating more cash flow, to service that debt. When the $1 million property was 750K in that primary market, it's probably a lower cap rate, generating lower cash flow, and it's probably having a harder time servicing that debt. And LTV is the same, but your ability to pay the debt service in both deals is different because they likely have different debt service coverage ratios. And I'm overly simplifying this analysis. So when thinking about LTV versus DSCR, it's important to understand that the risk with either is not the same, right? And that's basically the example that I just provided there. But LTV only really matters when you have to sell the property. In terms of if you're a forced seller and you have a loan balance that's really high and or maybe exceeds the value of the property, well, then you're in a really tough spot because you maybe have to bring capital to closing to get out of it. But if you're able to continue servicing your debt, LTV matters slightly less because you're servicing your debt. You're not a forced seller. You're not forced to do anything. And again, this assumes that you don't have like loan terms that are compressing the timeline of when you have to make a decision. So I would rather have, again, to use more of a numerical analysis, a loan at 80% LTV where I have 1.25x debt service coverage than a 65% LTV loan and maybe a more core asset where I have 1.15, X debt service coverage. Now, there is some nuance here where maybe that debt service coverage is a little bit more dependable because you're in a better market, a little bit more of a core market. That could be true. But again, that's going to be dependent on a whole bunch of other variables. But generally speaking, if I'm generating cash flow, predictable cash flow that covers my debt at a 1.25 versus let's just assume for example's sake, the same level of predictability from a cash flow standpoint that covers my debt at a 1.1 or a 1.15, even if that LTV is lower, I feel much more secure with that other piece of debt, that 80% LTV loan. So when we're working through the refi process, how this manifests itself is when we see banks who are offering the same LTV, we want to work with the bank, one that is underwriting to a lower DSCR because that's probably going to allow them to maximize their loan proceeds, which is just a specific nature of selecting a lender. But that also allows us a little bit more room from an analysis standpoint too when actually picking a lender to work with. But from a risk profile standpoint for us, we care a little bit more about DSCR than LTV. And granted, this is all within reason, right? Like even if we had positive DSCR or on paper 1.15, 1.2 DSCR and a 90 LTV loan, that's not a stabilized loan that we would ever want to work with, and nor would a bank even give it to us to begin with. Principle number 4, when selecting lenders and thinking about who we want to work with and the term sheet that we want to sign, is how easy is that lender to work with? And I think this is oftentimes overlooked when comparing a couple of term sheets from a couple of different lenders. Let's say you're on the buy side or on the refi side of a deal. And sometimes it's hard to know this unless you're working with a broker who can provide you some insight into how easy both lenders are, or you know some of their other borrowers. You can ask for some referrals. And oftentimes this comes with a little bit of experience and just volume of doing deals over a long period of time with different lenders. But it's important to evaluate how easy it is to work with the lender that you're potentially going to be working with. And what does that mean, right? What does easy mean? Well, post-closing, that can mean how easy is to work through the draw process. For value-add investors, that's a big part of their business plan, right? Is funding renovations, submitting draw requests to continue pulling capital off the loan and continue investing into more renos. Do they only allow you to do one draw a month? Or is it as needed? Do they charge you inspections for the draws, right? That's something that you got to include in your underwriting. If they're going to charge you a $500 inspection fee every time you submit a draw, depending on your project, that might become meaningful money. How accessible are the different folks in their servicing department? Whether you have a question about a loan payment, or you are trying to get a payoff, or you're trying to get a year-end interest paid statement for your accountant. Again, some lenders are much more accessible than others, and it's important to compare. Before you get to closing, how quickly can they work through their credit committee and their underwriting committee? Do they meet once a month? And if you miss that meeting with your loan, well, you got 30 days till the next one. Do they meet every 2 weeks? Do they meet every week? Do they even need to take the loan to credit committee? Like, there's all kinds of different questions that you should ask here to understand what the timeline to closing your loan looks like. What type of third parties do they need to order, right? And what trickles down to you as an expense, therefore, because those are borrower paid expenses. How quickly can they go from term sheet to submitting the deal to their underwriting to, working through the rest of the process? So again, there's all different kinds of examples of a lender being easy to work with. But in our world, if we have two identical lenders, we're always going to pick the one that's easy to work with, obviously. But even if we have two identical lenders, maybe one is slightly more compelling on rate, 0.05%, 0.1% difference, but the other one allows us to work through our draws quickly and efficiently. They have a great servicing team and they can close in 45 days. This other one usually takes 60 to 75. And sometimes there's risk there. We're going to work with the lender that's issuing a more expensive term sheet because we have that security of close and we know it's going to be easier to work with them post close. So, big four principles here in recap: flexibility with our exit, which translates to minimal prepay structures, interest only with no escrow. We want to control our capital. We don't want to relinquish control of it to the bank. We care about DSCR over LTV and think that's a better metric to look at in regards to risk. Lastly, ease of working with lenders is very important to us. Hopefully, you learned something in this episode. And if you did, please consider leaving the show a rating and review. Also, subscribe to the show on both Spotify and iTunes, depending on what platform you're listening to it, so you're notified when we release a new episode. But again, thank you all for listening, and I'll catch you guys on the next episode.